A customer walks up to a rental counter, signs a few screens, takes a key, and drives away in an ordinary sedan for about $80 a day. From the customer side, the transaction is obvious. There is a car, there is a daily price. The company owns the car, the customer pays to use it, and whatever is left after cleaning and a little maintenance looks like profit. But the owner started spending money long before this customer arrived. The car had to be acquired, it had to be financed, it had to be registered, moved, stored, cleaned, inspected, and made available at exactly the place where demand appeared. And while the customer is finally paying for it, the odometer is turning, the tires are wearing, accident exposure is increasing, and the car is moving one step closer to the day when the rental company will have to sell it to somebody else. So the $80 is real revenue. It just does not answer the question we actually care about. If we rent this car for $80 today, how much did we actually make? We cannot answer that yet. We will have to follow this exact car all the way from the day we buy it to the day we sell it. The first mistake is thinking that a rental company sells cars. It does not. It sells temporary access to a finite amount of time inside those cars. One vehicle can only be in so many customer hands over a year. Hertz actually reports a metric called available car days. Avis uses available rental days in its utilization calculation. The definitions are not identical in every detail, but the owner-level idea is simple enough. Each day a car is available is a piece of capacity. Some of those days are rented, some are idle. Some disappear into maintenance, recalls, damage, cleaning, transfers, or other operating interruptions. And when an unused day ends, you cannot put it on a shelf and sell it next Tuesday. That day is gone. This is the same basic problem an airline has with an empty seat or a hotel has with an empty room. The ownership cost exists whether the capacity is sold or not. But a rental car has an extra problem. A hotel room does not accumulate 40,000 miles and then get auctioned as a used hotel room. The physical asset itself is changing while you monetize the capacity. That distinction is what makes rental cars strange. The company is trying to sell as many useful car days as possible without making the underlying car uneconomic by the time it exits the fleet. So before we ask what our car costs, we need to ask how much of its time we can actually sell. Suppose our car sits in the fleet for 18 months. That is roughly 548 calendar days of ownership. But calendar days are not the same thing as available days. There will be time when the car is not ready for a renter at all. Maybe it is waiting on a tire. Maybe it is in a body shop. Maybe it is being moved from one location to another. Maybe a recall temporarily takes it out of service. For our model, we will assume 520 of those days count as genuinely available rental capacity. That number is an illustration, not a claim about Avis, Hertz, Enterprise, or the industry. Public companies aggregate hundreds of thousands of vehicles across markets and vehicle classes. We are building a simple owner model so we can see the mechanism. Now imagine we rent the car on 75% of those available days. That gives us 390 rental days over the holding period. The immediate temptation is to say 75% is too low. Why leave one day in 4 unused? Why not slash the price until every car leaves the lot every morning? Because 100% utilization is not the same thing as a healthy fleet. If every vehicle is gone, the next customer has nothing to rent. A late return can break the next reservation. A maintenance event can force an upgrade. A one-way rental can empty the wrong branch. A recall can suddenly remove capacity that looked available yesterday. A perfectly full fleet has no shock absorber. And current public numbers show why there is no magic industry percentage. Avis reported total utilization of 72.6% in the second quarter of 2026. Hertz reported total utilization of 79% in the same quarter, or 81% when it excluded elevated recall impacts. Hertz also reported different utilization in its Americas and international businesses in 2025. Those numbers are not directly interchangeable. The companies define and operate their fleets differently. That is exactly the point. There is no credible rule that says 80% is always correct or that 100% is always the goal. The owner is optimizing rate times utilization, not utilization by itself. Take two versions of the same car. One earns $70 on 390 rental days. That produces $27,300 of base rental revenue over our modeled holding period. Now imagine we cut the realized rate to $60, but increase rental days to 440. Revenue becomes $26,400. The busier car actually produces less base rental revenue. Or the reverse can happen. A lower price can create enough extra rental days to more than compensate for the discount. So every pricing decision creates the next question. How much revenue can this car generate from a finite number of days? And that still tells us nothing about the hurdle those dollars must clear. To understand that, we finally have to buy the car. Rental companies do not necessarily pay the same number printed on the window sticker. Avis says the initial cost of its vehicles is recorded net of manufacturer incentives and allowances. That tells us fleet economics can differ from consumer MSRP. It does not tell us that every rental company gets some universal 30% discount. There is no defensible single number like that in the evidence we are using. There is another distinction that matters even more. Some vehicles are what the industry calls program vehicles. Under certain arrangements, a manufacturer agrees to repurchase the car later or guarantees a depreciation outcome as long as the rental company satisfies conditions such as holding period, mileage, and vehicle condition. Other cars are risk vehicles. The rental company owns the residual value risk. If the used market is weak when the car is sold, the rental company eats the result. Program cars are not just a story from decades ago, they still exist. But their importance varies sharply. Avis reported that program vehicles were about 16% of its average rental fleet in 2025, only about 3% in the Americas, and much more internationally. For our example, we are going to make the car a risk vehicle because that lets us see the full ownership problem, and we need a set of explicit assumptions. Let's say our ordinary car enters the fleet at a modeled net acquisition cost of $30,000 after whatever fleet-specific terms apply. We finance 80% of that amount. We plan to hold it for 18 months. We expect to sell it for $20,000 before selling costs. Those are not reported industry averages. They are round assumptions for one hypothetical vehicle. The real purpose is to see which numbers matter when the assumptions move. The moment we write down an expected sale price, the car changes meaning. It is no longer just equipment we rent today. It is also used car inventory we plan to sell tomorrow. Every morning, our car is participating in two markets at the same time. In the rental market, we ask what someone will pay to drive it today. In the used car market, we are quietly asking what somebody may pay to own it months from now. Those two prices are connected, but not mechanically. Hertz describes residual value as something affected by make, model, age, condition, mileage, sale timing, sale location, supply and demand in the used market, and even actions in the new car market. That last part is especially important. A rental company can buy a vehicle under one set of assumptions, then watch the manufacturer change incentives or new car pricing later. Suddenly, the used version competes with a cheaper new version. The rental company did not change its operation, but the exit value moved anyway. The used market itself moves constantly. In July 2026, Cox Automotive's Manheim Index showed adjusted wholesale values up year over year, but down month over month. That does not predict what our car will be worth 18 months from now. It proves why pretending the exit value is fixed would be dangerous. This also explains why depreciation should not be narrated as a little meter that subtracts the same number every day. Time matters, mileage matters, condition matters, the market matters, the manufacturer matters. Our car does not lose exactly $18.43 every midnight. But it does have a future value that we are consuming and exposing to market risk while we earn rental revenue today, which creates the central paradox of the business. The more we rent the car, the more useful the asset becomes as a revenue machine. And the more we use it, the more we change the asset we eventually have to sell. An idle car feels safe because no customer can crash it, but idle is not free. The financing clock is still running. Time is still passing. New model years are still arriving. The used car market is still moving. The car still occupies fleet capacity. And most importantly, the rental opportunity for that day disappears forever. So the operator cannot protect residual value simply by refusing to rent. At the other extreme, a heavily rented car earns more revenue but takes on more miles, service events, wear, and damage exposure. The right question is not whether driving the car is good or bad. It is whether the next rental day creates enough contribution to compensate for the incremental costs and the effect on the asset. In our model, a rental day produces $70 of base revenue. Later, we will add ancillaries. Against that day, some costs are variable. The car needs cleaning and inspection. More miles bring maintenance closer. Damage probability exists, and over enough miles and time, the resale outcome may change. But we should not pretend we know a universal depreciation per mile charge. The public filings do not give us one clean number that applies to every car. This is why fleet managers care about both utilization and residual values. Utilization monetizes the time. Residual value determines how expensive that monetization ultimately was. And the next thing that changes the value of a rental day is not even the car itself. It is the address where the car is parked. Put our sedan at a major airport, and the demand can be unusually concentrated. Travelers land at the same place. Many need a car immediately. Some are on business accounts. Some are making a time-sensitive leisure trip. The operator gets a dense stream of demand without building that traffic from scratch. But the airport knows exactly how valuable that access is. At Seattle-Tacoma International Airport, for example, current Port of Seattle terms require rental operators to pay the greater of 10% of gross sales or a guaranteed minimum. That exact structure is specific to Seattle, not a universal American airport rule, but it shows the owner trade-off clearly. Strong demand can come attached to a real concession burden. Now move the same car to a neighborhood branch. The customer mix changes. Enterprise built much of its network around neighborhood locations, while many competitors historically concentrated on airports. In fiscal 2023, Enterprise said contracted business, including business-to-business and insurance replacement rentals, represented a majority of its rental days. That does not mean insurers generate most of Enterprise's revenue. It tells us neighborhood demand can be structurally different from tourist demand. A driver whose own car is in a body shop may need transportation close to home. A local business may need a temporary vehicle. A customer may value pickup convenience more than access to an airport facility. So the same sedan can face different rate, utilization, and cost equations just a few miles apart. The airport may offer concentrated demand and higher willingness to pay, but charge for access. The neighborhood branch may avoid some airport costs, but depend on a different network of relationships and local demand. The car itself did not change. The economics around it did. And even after we pick the right location, the vehicle refuses to stay where the spreadsheet wants it. Imagine our car leaves Los Angeles and gets returned in San Francisco. From the customer's perspective, that is convenience. From the fleet manager's perspective, one unit of capacity just migrated hundreds of miles. Maybe San Francisco needs the car. Maybe it already has too many. Maybe Los Angeles needed that exact class tomorrow morning. A rental fleet is constantly drifting because customers do not return demand in the same pattern in which they create it. The operator can respond with pricing. It can use one-way fees or incentives where appropriate. It can move vehicles with staff or transport services. It can let the imbalance resolve through future customer trips. But the physical car cannot teleport. And once it returns, it is not automatically ready for the next customer. Someone has to inspect it. The fuel or charge status has to be handled. The interior and exterior may need attention. Damage has to be checked. The vehicle may need to be moved across a facility. If there is a service issue, it may leave the sellable pool entirely. That means utilization is not only a demand problem, it is an operations problem. A branch can have customers waiting and still fail to monetize a car because the car is in the wrong place, in the wrong condition, or in the wrong stage of turnaround. For our model, we are going to assume 28 calendar days over the 18-month hold never become available rental days because of these kinds of operational interruptions. Again, that is an illustrative assumption, not an industry benchmark. The point is that a lost car day can be created by weak demand or by weak execution, and when the car finally gets back to the counter, another accounting illusion appears. The customer's bill can be much larger than the base rental price. That does not mean every extra dollar is margin. A rental receipt can include the base vehicle charge, upgrades, additional driver products, fuel-related products, toll handling, protection products, taxes, airport fees, and facility charges. Those lines do not all have the same owner economics. Some are operator revenue. Some are products that come with their own operating or claims costs. Some are taxes or government charges. Some are amounts the rental company collects for somebody else. Seattle gives us a very clean example. The port's customer facility charge rules say those charges are collected on behalf of the port, held in trust, separately identified, and that the rental company has no legal or equitable interest in them. So if the customer sees that charge on the receipt, it would be wrong to treat it as rental company profit. At the same time, the rental operator can owe the airport a concession payment tied to gross sales. Now the receipt looks very different from the owner's perspective. One line may be money that passes through. Another may be revenue that triggers a concession obligation. Another may be a protection product with real expected claims expense behind it. This is why the familiar customer complaint that the final bill is much larger than the advertised daily rate does not directly tell us how profitable the rental company is. The owner's job is to separate gross customer spend from economic revenue and then separate economic revenue from contribution. For our one-car model, we will make one simple assumption. After the costs associated with ancillary products, our car contributes an additional $8 per rental day on average. Across 390 rental days, that is $3,120 of modeled ancillary contribution. That gives the car more economic support than base rent alone. But then our car comes back with damage. Suppose the repair itself costs money, but the larger problem is that the car sits unavailable while the work is completed. The company may recover some costs through a protection arrangement, customer responsibility, or another claims process. That does not restore the missing rental days. If the car spends a week waiting for parts and bodywork, the branch loses a week of potential capacity. If demand is strong, another vehicle has to absorb that demand. If no replacement exists, bookings may be lost or customers may need upgrades. The damage can also affect the exit. Condition is one of the factors that matters when the car is eventually sold. So there are at least 3 owner questions hiding inside one dent. What does the repair cost? How long is the car unavailable? And what, if anything, happens to the future sale value? We are not going to pretend those numbers are universal. For our model, we will simply allocate $1,200 over the entire 18-month hold to damage and claims-related vehicle cost, plus separate turnaround and maintenance assumptions later. The important idea is that downtime has an opportunity cost even when the repair bill is reimbursed. A company can be made whole on a piece of metal and still lose the revenue opportunity that disappeared while the car was in the shop. Eventually, as the car ages, the owner stops asking when it will be ready for the next renter. The owner starts asking whether there should be a next renter at all. Because there is a second customer waiting at the end of this business, Avis says risk vehicles can leave the fleet through direct-to-consumer sales, online auctions, direct-to-dealer sales, and traditional auctions. That means the rental company is not just operating a temporary access business. It also needs a disposal system capable of converting hundreds or thousands of aging assets back into cash. And the sale price matters because sale proceeds are not automatically profit. If we buy our car for $30,000 and later sell it for $20,000, the $20,000 did not appear from nowhere. It is the remaining value of the asset we already paid for. The useful number is the economic value lost between entry and exit, together with the revenue and costs generated while we held the car. Recent Avis results make this especially clear. In its cash flow reconciliation, Avis showed net losses on vehicle sales in 2025 and 2024 after showing a large net gain in 2023. So the claim that rental companies simply make their money by selling cars is too crude. Sometimes disposition beats the value the company had expected. Sometimes it misses. The exit result can improve a mediocre rental cycle or damage a good one, and the market can move independently of the rental counter. A stronger or weaker wholesale market changes what buyers will pay. New car pricing can change the comparison. Mileage and condition change the specific vehicle. Only now, after the second customer has paid us, do we finally have enough information to answer the question from the opening scene. What did our one car actually create? Here is our deliberately simplified 18-month model. We assumed a net acquisition cost of $30,000. We assumed 520 available days and 75% utilization, giving us 390 rental days. At $70 of realized base rental revenue per day, the car produces $27,300 of rental revenue. We added $8 of modeled ancillary contribution per rental day, or $3,120. Now the costs. We assumed 80% financing and roughly $2,160 of interest over the hold. We will allocate $1,800 to maintenance, tires, and service, $1,400 to cleaning and turnaround, $1,200 to damage and claims-related cost, $650 to registration and vehicle-level taxes, and $650 to repositioning and other direct movement. Then we sell the car for our modeled $20,000 and spend $500 getting it sold, leaving $19,500 of net residual proceeds. That means the economic vehicle value loss is $10,500, $30,000 in, $19,500 back. Now put the pieces together in the more useful way. $27,300 of base rental revenue plus $3,120 of ancillary contribution minus $2,160 of financing cost minus $5,700 of the other direct vehicle costs we just modeled minus $10,500 of economic value loss. The result is about $12,060 of vehicle-level contribution across the 18-month hold. That is roughly $8,040 per year if we annualize it mechanically. And this is where it is easy to fool ourselves again. $12,000 is not branch net profit. We have not paid the branch manager. We have not paid rent on the facility. We have not paid for reservation systems, payment processing, marketing, customer support, corporate staff, or every other layer required to make 500 cars behave like a business instead of a parking lot. Our single car can work economically, and the company around it can still fail. So now we have to scale the machine. Take 500 versions of our modeled car in one U.S. metro area. In steady state, our simple model annualizes to a little over $4 million of vehicle-level contribution across the fleet before branch and corporate overhead. That number is not a forecast for Avis, Hertz, Enterprise, or an independent operator. It is simply 500 copies of our illustrative car lifecycle. Now the real organization appears. We need multiple operating locations or a large consolidated facility. We need people to prepare cars, move cars, inspect cars, handle customers, manage claims, and manage the fleet. We need software and reservation distribution. We need payment processing. We need local management. We need marketing and customer acquisition. If part of the fleet sits at an airport, we may owe concession and facility obligations specific to that airport. For the branch model, let's make another explicit assumption. All of those operating layers consume about $3.1 million per year. Subtract that from roughly $4 million of annualized vehicle-level contribution, and we are left with about $900,000 before broader corporate costs, taxes, and any items our simple model omitted. That can be a viable business. It can also disappear very quickly if one or two assumptions move. This is why scale alone does not solve the economics. Enterprise says its broader mobility portfolio operates more than 2.4 million vehicles through more than 9,500 neighborhood and airport locations. That tells us the operational system can become enormous. It does not give us permission to reverse engineer Enterprise's private margins from our hypothetical branch. The key owner insight is smaller. 500 cars multiply both the earning capacity and the mistakes. A $1,000 miss in residual value on one car is annoying. A $1,000 miss across 500 cars is $500,000. And that is how a branch can look extremely busy while the investment underneath it has a bad year. Public rental companies separate vehicle depreciation from vehicle interest for a reason. Avis reported more than $3 billion of vehicle depreciation and lease charges net in 2025, and about $918 million of vehicle interest net. Those are company-level numbers, not costs for our car. But they show that the fleet creates two different financial pressures. The asset changes value, and the capital used to hold it has a price. Avis also reported more than $19 billion of debt under vehicle programs at the end of 2025. The cars support vehicle-backed financing. That is powerful because a physical fleet can be financed at enormous scale. It also means the value of the collateral matters. If fleet values fall faster than expected, financing structures can require actions to restore the relationship between debt and collateral. This is similar in spirit to a leveraged investor being asked to protect a loan when collateral falls, but we should not pretend a rental securitization is literally a retail brokerage margin account. The owner lesson is enough. Resale value is not just a number that appears at the end of the story. It can affect financing while the fleet is still operating. So imagine our 500 cars still have healthy customer demand. The counters are busy. Utilization is fine. Revenue per day is fine. But interest rates rise and the used car market softens. The front of the business can look successful, while the back of the balance sheet moves against it. That separation is exactly why Hertz's electric vehicle cycle is useful, not because electric cars are inherently bad rental cars, because the episode shows what happens when rental activity and asset economics stop moving together. First, the chronology matters. Hertz filed Chapter 11 on May 22, 2020, during the sudden collapse in travel demand caused by the pandemic. The Tesla strategy came later. In October 2021, Hertz announced an initial order of 100,000 Teslas targeted by the end of 2022, along with charging infrastructure. That announcement does not prove that exactly 100,000 Teslas were ultimately acquired. It tells us what Hertz announced it intended to order. Then, the economics changed. In January 2024, Hertz said it planned to sell roughly 20,000 electric vehicles, about one-third of its global EV fleet at that point. By the first quarter, it had increased the intended 2024 dispositions to 30,000 vehicles. Hertz's 2024 annual report gives the mechanism in unusually clear language. Management said the EV disposal groups reflected supply exceeding customer demand, elevated EV damage and collision costs, and declining EV residual values. For 2024, Hertz reported $223 million of incremental net depreciation related to EV sales, and by year-end said those disposal groups were substantially complete. By its 2025 annual report, Hertz said EVs represented less than 10% of its U.S. operating fleet. The wrong conclusion is that electric vehicles cannot work in rental. The useful conclusion is narrower. A car can still be a car. Customers can still rent it. The branch can still generate transaction days. Yet the owner can discover that the demand mix, repair economics, and resale assumptions are worse than expected. And one of those inputs can be influenced by a company outside the rental operator's control. If new car pricing changes, the used version can become less valuable after the rental company has already bought it. That is the hidden danger in our opening $80 rental day. The customer sees today's price. The owner has to survive today's price and tomorrow's resale market at the same time. So now we bring that lesson back to our own 500 cars and start breaking the model on purpose. Our base one-car model produced about $12,060 of vehicle-level contribution over 18 months. Change only utilization. Instead of 75% of 520 available days, assume 65%. That removes 52 rental days from the hold. At $70 of base revenue and $8 of ancillary contribution per rental day, that is a little over $4,000 of lost gross contribution opportunity before considering any variable costs we save by driving less. Our $12,000 cushion suddenly looks much thinner. Now restore utilization and cut the realized base rate by 10%, from $70 to $63. Across 390 rental days, base rental revenue falls by $2,730. Now restore rate and utilization, but miss the expected exit by 10%. Instead of selling for $20,000, the car sells for $18,000. Holding selling costs constant, our contribution loses another $2,000. Now restore the exit and raise our modeled financing rate by 2 percentage points on the financed portion of the car. Over 18 months, that might add roughly $720 to our simplified financing cost. No single one of these scenarios is a forecast. They are controlled tests. They show why the daily rate alone is almost useless as an investment answer. The operator has to be right enough on several linked variables at once. And now scale the utilization question to the branch. 500 cars at 75% utilization are serving demand equivalent to roughly 375 fully utilized cars at any moment in the simplest possible picture. What if we own only 450? If demand stays identical, theoretical utilization rises toward 83%. We reduce the capital tied up in 50 vehicles. We reduce some depreciation and financing exposure. The return on the remaining fleet could improve. But the smaller fleet also has less slack. A recall, maintenance wave, one-way imbalance, or demand surge can produce stockouts and lost bookings. So fewer cars are not automatically better either. This brings us to the decision that matters more than any average industry margin. Demand looks strong tomorrow morning. We operate 500 cars. Should we buy car number 501? The answer is not simply whether we can rent it. The answer is whether the rental contribution we expect during its holding period is large enough to compensate us for acquisition cost, financing, operating cost, downtime, expected residual loss, and the incremental overhead required to support it. If the next car only works when we assume the highest rate, the highest utilization, no meaningful downtime, cheap financing, and a perfect resale market, we do not have a margin of safety. We have a collection of optimistic assumptions. If it still creates an attractive return after we lower utilization, lower rate, raise financing cost, and haircut the exit value, then the economics are much more resilient. And now, finally, we can go back to the sedan from the opening scene. The customer paid about $80 for a day and thought the transaction started when the keys arrived. But for the owner, the transaction started months earlier, when capital was committed to the car. It did not end when the customer brought the car back. It did not even end after the last renter. It ended when another buyer paid for what was left of the asset. That is why a rental car company is not simply selling days behind the wheel. It is managing the financial life of a depreciating asset, one expiring car day at a time. And until you know utilization, acquisition cost, downtime, financing, and the final sale price, the daily rental rate tells you almost nothing about whether you made a good investment.